Jim Anaya, Dean Anaya. I'm glad that you could all join us for this discussion on the pandemic we're experiencing and its effect on the financial markets. This is spring break, and normally we wouldn't be having something like this during this week, but these aren't normal times. It's been a week since we stopped having classes in the building. Our lives and the school semester have been disrupted, but happily the University of Colorado Law School is not closed. After a week in our new reality, we want to start to bring back opportunities for community engagement beyond classes. I want to encourage everybody to use Zoom or other media to continue to hold the kind of events that bring us together. As you know by now, Zoom is not the same as in-person interaction, but still it can bring us together in meaningful ways. Today's the first in a series of events on Zoom that the law school will be holding through the end of the semester. I want to announce that this Thursday at noon, I'll be holding a lunch with the dean. This will be an opportunity for me to make or follow up on announcements and for students, faculty, and staff to ask questions or share insights. I'll be joined by others in the law school's administration. Look for more information on this in your email and my law. I'd like to now turn the program over to Professors Gerding and Orian, who will lead us in exploring financial aspects of the COVID-19 crisis and related business law topics.
Well, thank you, Dean Anaya, for allowing us to have this webinar today, and thank you all for joining us in the middle of your spring break. We're really happy to give this webinar to you all today. We know there's quite a bit of anxiety, not just about our health situation, but also about our economic situation. So in the theory that knowledge is power and will give us a little bit more comfort about what is going on, we wanted to teach to you today. We're at a pretty unprecedented moment in our history and in our economic history. COVID-19 has meant that our economy has basically gone from a full sprint to a full stop in a matter of just a few weeks. And I should note that both Professor Orian and I are having to make up this lecture largely on the fly. So just this morning, the Federal Reserve launched a very unprecedented or very massive set of interventions in financial markets that we're only beginning to digest, but we'll try to make sense of for you today. And meanwhile, in Congress, both the House and Senate are still debating over a $1 trillion stimulus package. So we are quickly being overtaken by events, but we want to at least give you some overall context for ways to think about what's going on in the economy and what's going on in our financial system. But please bear with us because a lot of what we are saying might be quickly obsolete, even in a matter of hours. So America has suffered from major economic crises before, but this current crisis is different. It didn't originate as a financial crisis, as a real estate crisis, or a banking crisis. It truly comes from an external shock. And this means that many of the tools, the policy tools that we have to deal with crises are not exactly well suited to dealing with essentially an economy being put on pause in very short notice. So the true recovery and the traditional tools that we have for dealing with economic crises won't really start until the economic recovery begins, and that only starts when the health crisis is over. For now, the job that policymakers have in both the federal and state levels is to keep households, businesses, and the economy afloat until the lockdowns and the social distancing end. It's essentially to keep a very massive credit system floating. And when we're talking about a credit system, we're talking about very concrete and immediate problems that households and businesses face. So for households, it's a question of, will I be able to make my mortgage payment on April 1st? Will I be able to make my rent payment on April 1st? For businesses, it's, do I have enough cash on hand to pay my employees? Do I have enough cash on hand to pay my other creditors, my suppliers, to keep my business basically in a freeze period until the health crisis is over? That's the situation that we see for households, for individuals and businesses individually. Collectively, it means our entire economy is essentially hitting pause for the next couple weeks, possibly months. And one of the things that we're going to talk about today is just how fragile our economy has turned out to be, how little cushion households, businesses, financial institutions, financial markets have, even in the middle of a very long economic boom. So long-term, we have to think about how to make households, businesses, and our financial system a lot more robust and a lot more resilient. But immediately, again, the goals are twofold for policymakers. First, just to keep individuals and households safe, to make sure that they're sheltered in their homes and they're able to afford food and they're not evicted or foreclosed upon. And second, to keep as much of the household and business finances and the machinery of the economy intact. So now Professor Orian is going to take over and talk a little bit about an outline of the rest of our webinar.
Hello, everybody. Just 1 second. Let me try to share my screen. Okay, is the screen share working? It's a bit of a different configuration here. It's working? Great. Yeah, so let's just talk about what we're going to speak about in the next hour. So we're going to talk about the Macroeconomic Toolkit. These are the tools that policymakers have at their disposal to try to stabilize the economy. We're going to talk about the Federal Reserve. As Erik just mentioned, we just had a very important announcement, very dramatic announcement this morning. So the key theme here is going to be the Federal Reserve going from fixing the plumbing, which is mainly about financial markets, technical financial markets issue. And now we see that with the delays in the legislative branch passing legislation, the Fed has actually moved this morning to basically backstopping the entire U.S. economy, or almost the entire U.S. economy. So very dramatic development. We'll talk about that. We'll talk about the unprecedented stimulus package that is shaping up and would hopefully pass in the upcoming days. We'll talk about mass forbearance. So when Professor Gerding was speaking about how are people going to pay rent or pay their mortgage or pay insurance premiums, etc. One of the potential responses could be basically private law changes that would prevent people from defaulting in a legal sense. We'll talk about contract and bankruptcy aspects, and finally, I see you can see it on the last point here. What happens when the dust settles? So this is not just a one-off event. This is something that is going to have long-term consequences for the U.S. and frankly for the global economy, if only for the simple reason that the virus itself could flare up again, it could mutate. We're living in a world where this type of event that we're just experiencing has a much greater probability of recurring than we thought just a few short weeks ago. Okay, 5 key themes that we would like to offer. One is these problems are legal. They're not just about macroeconomic policy, which means that all of us as a community, as a legal community, there are things that we can do both to contribute to the conversation about the policy response, and also on the ground to help members in our broader community, small businesses, employees, etc., that will need whole new types of legal services and potentially on quite a large scale. Second theme: how does the system or the law bend without breaking? Okay, we need to adapt in ways that show flexibility, and in ways that just like Professor Gerding said, we're putting the U.S. economy on life support. Okay, this is not the time to. We're not trying to stimulate the economy in the traditional sense. We're trying to buy ourselves just enough time so that irreparable damage is not caused when things do look up. Policy will be messy. Okay, and we're already seeing this. There's a big trade-off of time and speed versus making the more careful, principled distinctions that we've all been training to make for years and decades. Winners and losers. We ignore the vulnerable in our society at our own collective peril. Okay, so that is obviously true for things like health insurance at the public health level, but it's also true for the social safety net. So supporting vulnerable communities is not just a matter of a moral obligation, which is of course extremely important. It's also a matter of preventing a very quick escalation in economic policy. And finally, how do we rebuild the economy when the dust settles? So with that, I'll pass it back to Professor Gerding.
Thank you very much. So I'm going to talk now in the next segment about the traditional tools that governments have in the toolkit to deal with financial crises, recessions, and even depressions. And this was a toolkit that was developed throughout the late 19th and 20th century. As I noted before, we have a fairly well-developed toolkit, but this time is truly different. We are facing, again, what economists often call an exogenous shock. So none of the tools that we have are going to end the health crisis. But as Professor Orian noted, the goal here is not to end the health crisis. It's not even really to stimulate the economy. It's basically to provide life support until the health crisis ends. So there's two basic tools that many of us learned in our macroeconomics class way back in undergraduate days, and that's monetary policy and fiscal policy. So first, governments respond to recessions and depressions with monetary policy. And the idea here is to keep interest rates as low as possible to stimulate borrowing and investment and to keep credit flowing. As an intellectual history, Milton Friedman and Anna Schwartz became famous for arguing that it was monetary policy or tight monetary policy, too high interest rates, that were really the root cause of why the Depression became so bad. There's a problem, though, that we're seeing in real time with monetary policy. And that is that interest rates have already been extremely low for an extremely long period of time, going back even to the global financial crisis. So the Federal Reserve has slashed interest rates a little over a week ago, but the interest rates are now close to zero and are facing what is often called a zero bound. So the economy is in what economists often call a liquidity trap. And this has led to the Federal Reserve revisiting and dramatically expanding some very unconventional monetary tools, including the really jaw-dropping action that the Federal Reserve took this morning. So Professor Orian will be talking about that particular action, the unconventional monetary policy, or what's often called quantitative easing, or QE, in the next segment. For now, I want to just outline the second major tool that governments have to combat recessions, financial crises, and depressions, and that is fiscal policy. So the big intellectual heavyweight to Milton Friedman was John Maynard Keynes, whose thinking really shaped US and many European countries' responses to the Great Depression in the late 20s and early 30s. The basic idea of Keynesian macroeconomic policy is to have massive government spending, often coupled with tax cuts, to really stimulate aggregate demand in the economy. So the idea here is have a demand style response where you're basically allowing businesses and households to basically expand their purchasing and their investment. And that's what Keynes argued stimulated the economy. Now, Keynesianism fell out of favor both among policymakers and in economics departments in the 1970s during during the prolonged inflationary shock that we suffered in the 70s. But Keynesianism has enjoyed a renaissance in the 21st century, so it's now Keynesianism is now being actively researched and taught and discussed in economics departments at CU and around the country. We also have a toolkit for dealing with banking crises. So Nadav will talk about this more in a moment, but dating back to the late 19th century and the early 20th century, policymakers started to respond to banking panics with a set of tools, including the government acting as a lender of last resort to banks that were suffering bank panics and essentially bank runs. And then in the 20th century, governments started to develop the idea of deposit insurance. And Professor Orian will talk in a minute about how those two kinds of interventions, the government acting as a lender of last resort and the government acting, providing deposit insurance, have been adapted in a very rough and ready way to respond first to the global financial crisis in 2007 and 2008, and then as late as last week and this morning to our current very different economic crisis. So now I'll turn it back to Professor Orian to talk about Federal Reserve actions.
Okay, so this is really, really exciting in a way. Obviously, a very unfortunate situation to be in. But you know, for those of us who are trying to make sense of the system, it's just a fascinating opportunity to see how policy gets made. So when we talk about the Federal Reserve, we're talking about two big items in the way that the Fed is addressing economic crisis at large and Corona in particular. So one is monetary policy, and this comes in two flavors: conventional and unconventional. We'll talk a little bit more about that. And the other one is lender of last resort. Okay, so that's emergency lending. Again, this comes in two flavors: conventional and unconventional. So let's start with monetary policy. The first response that the Fed had was to cut rates, which only 3 or 4 weeks ago were at almost 2%. Those rates were cut to zero. So this is what Professor Gerding talks about when he talks about the zero bound. The idea is to reduce the costs of credit to borrowers, and basically costs. These are short-term costs. They could not go down further. They've hit a floor. So the rate that the Fed controls directly is the overnight rate between financial institutions. That is currently at 0. The rates at which actual firms and households in the real economy borrow, those rates are still higher, right? We're not banks, and we're not borrowing overnight. We're borrowing for longer periods. So right now the prime rate to businesses dropped from around 5% to 3%, and the mortgage rate is currently at around 3.5%. Okay, so this is where we are. The turn from conventional monetary policy, dropping rates, to unconventional policy is about the Fed trying to reduce longer-term rates. Okay, and that was done in the aftermath of 2008. That is what we call quantitative easing, and the way this was done was by purchasing long-term government securities and long-term government agency securities that basically cut mortgage rates down. So these are securitized mortgages. So the Fed has started engaging in this type of action. That was already happening last week, and I think even the end of the previous week. So that is the $700 billion of purchases that were announced. And let me just just to show you quickly what this means. The basic idea is to keep long-term borrowing costs low. So we already saw pressures on, even in the Treasury market, the U.S. Treasuries. Rates started going up, okay, and this puts pressure on the entire set of borrowing in the economy, right? If the government's cost of borrowing goes up, then the cost of borrowing to corporations and households will go up. So the Fed is trying to put a ceiling under that by taking all of that supply of long-term bonds out of the market and onto its own balance sheet. Okay, this is what QE is about. It was quite effective. It was quite effective in the early 2010s. Lots of unintended consequences, but this is a different story. Now, Corona brings about issues that are even that require the Fed to go even further from this unconventional QE style policy, and we'll see later why. The basic problem is that the markets that the Fed needs to backstop are not only government and mortgage markets, right? It's like Professor Gerding said, it's the entire real economy now that needs to be backstopped and protected and contained and put on life support, okay? So this means assets that the Fed would not ordinarily purchase. This means corporate bonds. This means consumer debt. This means municipal debt. And let me just quickly show you what that looks like when we look at data. Okay, so this is triple B, the difference between triple B corporate bond yields. So basically the rate that the lower tier of investment grade corporations have to pay for their borrowing. Okay, so think of this as the kind of second tier large corporate debt. And this plots the difference between their cost of borrowing and the cost of treasury borrowing. Okay, so we're trying to bracket, to put aside the cost that the treasury pays and just look at the riskiness that investors attribute to this corporate debt. And what we can see is that over the months prior to Corona, this is fluctuating at an interval between 3 and 3.5%. Okay, So fluctuating here. And then you see this hockey stick when Corona starts, right? March 5th. We're going from 2.65. It's basically a straight line, okay? It's going all the way to 5.48, okay? So large increase in the cost of borrowing on corporate debt. Here's what the Fed is afraid of. If we go back to look at the 2008 crisis, this is the 2008 crisis. You can see here that during the 2008 crisis, it spiked. This spread spiked all the way to 10%. Okay, so these are simply unacceptable levels of borrowing costs from the point of view of economic policy, and the Fed is doing everything it can to in order to cut them, and we'll see in a moment why. Okay, so this is when we talk about monetary policy. Let's talk about lender of last resort now. So lender of last resort is the other main way in which the Fed supports the economy. And let me do a quick kind of impromptu visualization here. This is all done on the fly. You can imagine lender of last resort as three concentric circles. Okay, so at the very center, we start from that traditional role that Professor Gerding mentioned that central banks played since the 19th century. Okay, and the idea here is banks are fragile institutions. They issue short-term liabilities. They hold long-term assets. They're vulnerable to something called bank runs, right? When depositors try to redeem their deposits en masse. And the central bank is there to protect. The banking system by lending to it, with the nightmare scenario being a meltdown of the banking system. That basically destroys the money supply. That didn't turn out too well in the Great Depression. Okay, these are traditional central bank powers that can be used at any moment. Okay, that's not the big story about the Corona crisis. The big story about the Corona crisis comes from these two outer circles. Okay, so first let's move from here to here. So when we move from here to here, we're still within the financial system. Okay, so this is still fairly familiar to the Federal Reserve, but we're not talking about chartered. We're not talking about chartered banks. We're talking about something called shadow banks. Okay, so institutions that basically engage in bank-like activities, but they do it without bank charter and bank regulation. Okay, so if this rings a familiar bell from 2008, that's good ear training, because 2008 was to a very considerable extent about the shadow banking sector. And once again, the Fed is finding itself backstopping the shadow banking sector. So if you heard about the money market fund facility that was just set up last week, this is what that is about. Okay, so money funds, it's a very large sector. It's a $3 trillion plus sector that basically funds itself by issuing what are basically bank deposits. And the Fed invoked Special Emergency Authority, Section 13.3 of the Federal Reserve Act, in order to protect that from collapsing once Corona type pressure started. Okay, so this is two things. On the one hand, this is absolutely necessary. Okay, this is not the time to experience a massive collapse in financial markets. On the other hand, this is also very controversial, because we've put a set of reforms in place in 2010, the Dodd-Frank Act, that were intended to make sure that we will never again be in the position where we have to engage in this kind of lending. Okay, turns out we're there again. That's something we'll have to think about when the recovery comes. Okay, so that's the second kind of this mid tier. Now let's talk about the furthermost circle. Okay, that goes to the real economy. That goes to the kind of stuff that started trickling a little bit slowly last week. Okay, kind of piecemeal, and that this morning was made wholesale, trillion dollars large. Okay, and this is the Fed acting as a lender of last resort, not just to the banks, not just to bank-like entities in the financial, still in the financial sector, okay? This is the Fed backstopping the bulk of the bulk of the U.S. economy, the actual productive households, firms of the U.S. economy, okay? And how is this, so what is the Fed going to do here? The Fed is going to purchase corporate bonds, okay? These very corporate bonds that that we've just seen with the rising spreads, those are going to find themselves on the Fed's balance sheet in hundreds of billions of dollars to prevent a refinancing crisis for these corporations. The Fed has started lending to local government. Okay, so this is municipalities and states that the Fed is going to purchase their debt. The Fed is starting to backstop consumer debt, so credit card loans, auto loans, student loans. This is also part of a new facility that was announced. To those of us interested in international aspects of the situation, the Fed is extending dollar liquidity in the global dollar funding markets to 14 other central banks in order to try to contain the very, very serious pressures that are now experienced worldwide. Okay, the Fed is not just a local domestic lender of last resort; it's a global lender of last resort. Last thing I want to say about this, and this is particularly relevant to our community as lawyers, where does the legal authority to do this come from? Okay, and this is quite a complicated question. For as late as 2 weeks ago, Chair Powell, Fed Chair Powell, announced that the Fed simply does not have the legal authority to backstop private credit markets in this way. And there's a good reason why. So Section 14 of the Federal Reserve Act, which is the section that determines the types of assets that the Fed can purchase, only includes US government securities and securities that are guaranteed by the full faith and credit of the US government. In other words, Congress, okay? Congress has the power to ultimately determine what the Fed could purchase. What we're seeing now is this very creative and interesting use of the section that Professor Gerding was talking about, 13.3. 13.3 is not about purchases, it's about loans. But what we see is the Federal Reserve lawyers using all sorts of really creative and interesting legal tools. Okay, they're setting up conduits, they're using all sorts of interesting contractual terms in order to invoke this lending authority in a way that functionally amounts to buying stuff. Okay, so this is an interesting case in point about the power of lawyers and legal thinking. Why is this happening now? Well, Professor Gerding is going to talk about the stimulus bill, right? That everybody was hoping would pass in Congress yesterday. That didn't happen, right? Markets had to open come Monday morning. We all wake up from our weekend slumber, if you can call it that, under these conditions. And the Fed felt absolutely compelled to take this massive macro action that is basically coming on the heels of congressional inaction. Okay, at least for now. Okay, so these are the two things that it's very important for people to understand this very deep relationship between what Congress does and between what Congress doesn't do, and actions and Federal Reserve actions. Okay, so with that, we're going to discuss the stimulus legislation.
So let me just pause to underscore one thing that Professor Orian Pierce said, and that is that this is really a phenomenal action by the Federal Reserve. It's essentially putting a huge portion of the US economy on its balance sheet. And a second point that he made that we're going to be studying and talking about for years is the kind of interpretive creativity that the Federal Reserve and its chief lawyers use in order to get comfortable with a pretty major policy shift and a pretty major shift in interpretations of a core statute. So this is not going to be front and center news in the next couple of weeks, and maybe that's a good thing. But it's a truly extraordinary thing that happened this morning. And it really deserves a lot of careful consideration and study in a quieter moment. But I completely agree with Professor Orian here that this was probably necessary. So the market still dropped this morning after Congress failed to pass a bill over the weekend. But that might not be the baseline. The question is, what would markets have done had the Federal Reserve not acted? And more importantly than what happened with the stock market, what would have happened to the overall economy and the lending if the Federal Reserve had not acted? So I'm now going to talk about, shift gears and talk about the stimulus bills in Congress. We have a series of stimulus bills that have already happened. I saw a podcast the other day on slate.com that said, "Can Congress save the economy?" And at the end of the day, it's sort of up to them to do so. So we've seen two stimulus bills already. We saw one that was, let me get the figures straight here. We saw one on March 6th that was for several $1 billion that gave additional funding to the CDC, the FDA, the State Department, the National Institutes of Health. It had $4 billion for coronavirus tests. It had $1 billion in loan subsidies for small businesses. Now, ordinarily, that's serious money. But look at round two of the stimulus, which passed on March 18th, which is this past Wednesday. That bill, the budget impact was estimated at $100 billion. And it was for free coronavirus testing, 2 weeks of sick and paid family leave, money for Medicaid and food security programs like SNAP, and increased unemployment insurance benefits. Now we're talking in Congress about $1 trillion in stimulus. So just as the coronavirus is climbing up this logarithmic curve, so is the economic damage that's happening as the economy is in standstill. It's also going up that logarithmic curve. And it's no accident that it's also the amounts of stimulus that are going up that curve. So the current state of play, as Professor Orian here noted, was last night yesterday around midday, from what I understand, bipartisan talks to have a bipartisan stimulus bill stopped. Senator McConnell introduced a Senate GOP stimulus bill around midday. There was several hours to read that bill, and there were teams of lawyers and around the country furiously reading that bill and trying to understand it. And then there was a procedural vote in the evening DC time, where there was a tie 47 to 47. So that essentially meant that the Senate stimulus bill was going to be, was stopped dead in the water. Why was the vote 47-47? Because a number of GOP senators are now in self-isolation. So in the meantime, the House of Representatives has been furiously working on their own stimulus bill. And as of about an hour ago, I don't think it was publicly released. There's segments that I've seen, but I don't think the full bill is released. So what I thought I would talk about as a starting point is what's in the Senate bill, what was controversial about it, and how we might expect the House Democrats to respond when their own bill is released, which could come any minute now, it could come tomorrow. One of if we go sort of title by title, and this is a 300-page bill, so, or at least it was 300 pages on my Adobe printout. Title 1 of the Senate bill looked at a series of small business loans that the Small Business Administration was going to guarantee. And the loans were, the amount was about $300 billion in small business loans. The loans would be guaranteed by the government at 100%. There were some restrictions on how the loan proceeds were supposed to be used. Payroll, rent, mortgages, utilities. The loan amounts were capped per business at a certain ratio per the business's 2019 payroll. Businesses that take out these loans were not supposed to post any collateral. They were not supposed to have any personal guarantees from shareholders. There was supposed to be a 5.5% interest rate. And businesses would essentially have the principal amount forgiven and the interest rate would be repayable over a period of several years. So that's Title 1. Title 2, an expansion to the unemployment insurance program. Title 2 is also where you saw the essential payments to Americans based on a following formula: $1,200 for every adult, $500 for every child. And those tax payments, or those essentially a tax refund is the way it was structured. A tax refund would be capped or phased out for higher income people. So it would be essentially zero for households that made $200,000 or more. There was supposed to be a delay for employer payroll taxes, but those payroll taxes would ultimately still be owed. It was essentially a deferral for them. Title 3 was supposed to have 6 months of interest-free deferment for federal student loans and various healthcare and Medicare, Medicaid provisions. Title 4 of the Senate bill was $500 billion in pretty massive loan programs to 4 different kinds of industries. So 1 to passenger airlines, 1 to cargo airlines, 1 to national security businesses, which it's not entirely clear what's national security and what's not, and an additional lump sum to the Treasury to backstop Federal Reserve lending. It's Title 4 that it's my impression that caused the most controversy and the most concern among Senate Democrats and among commentators, because the terms and conditions of these very large loan programs are largely left up to the Treasury Secretary, so to Secretary Mnuchin. He would, under the Senate bill, he would have fairly broad discretion in terms of which firms are eligible. He would have fairly broad discretion on the terms and conditions of the loans. A couple of things that were extremely controversial yesterday, that there was very little oversight built into what the Treasury Secretary could do. So there was enormous discretion given to the Treasury Secretary. no oversight, very little governance of these programs. Second, there was very little aid for consumers in Title IV. Third, there were very few strings attached for these loans. So there were no restrictions on the ability of borrowers to declare dividends, to buy back stock. There were very light restrictions on executive wage increases. So, I mean, this is sort of where the rubber hits the road in terms of a real trade-off between speed and oversight, and a real trade-off between speed of a bailout and ensuring that sort of channeling the money to where we think who's most deserving or who we think might have the most macroeconomic impact. So that's one way of looking at the controversy around the Senate bill. I fully expect that the House bill is going to have quite a bit more oversight and quite a bit more governance around what the Treasury Secretary can do, or around some other body that can actually implement the industrial loans. And I fully expect that the House bill will probably have a lot more in terms of relief to consumers, relief to renters, relief to ordinary individuals. But we'll see when that bill is actually released. I do want to show you, though, or talk about a different point of comparison. So we're very focused on what the House and the Senate are doing, but we could also think about what other governments have done around the world and get some context in terms of just how massive the response has been and how different the response has been for other governments. So if we look at Denmark, for example, which has received quite a bit of press, Denmark had a huge stimulus plan relative to the size of the country. So in Denmark, the government assumed 75% of employee salaries from the private sector in the short term. And that was, in a sense, an effort to prevent mass layoffs, to preserve companies and to preserve employees on the payroll of companies in order to keep the economic machinery intact. The size of Denmark's plan is essentially 13% of that country's GDP over a period of the next 3 months. In the UK, Boris Johnson's government announced a pretty broad stimulus plan late last week. So they also have a wage retention program where the government would cover 80% of the salary of furloughed workers up to a cap of £2,500. They were going to defer value-added tax, so essentially the European version of the sales tax, for a period of time, and defer taxes paid by self-employed workers also for a period of time. UK had a statutory sick pay relief package for small and medium-sized businesses, and a 12-month holiday for all taxes paid by retail, hospitality, leisure, and childcare businesses in England, with certain caps to make sure that these tax holidays covered small businesses, small retail, hotels, restaurants, and childcare. And they offered businesses up to £5 million of loans to small and medium-sized businesses. So it's a little bit, to give you context, other countries are taking fairly dramatic steps it is a little bit of a gamble on those countries, but the calculus is that if they err too low and they are too slow with having stimulus funds flow to businesses and flow to households and individuals, if they're too slow, there might not be much of an economy when the health crisis ends. The flip side is if they err on the side of being too generous, there is a risk of inflation. There is a risk of pretty high budget deficits. But the gamble is that governments they can fix that on the back end through taxes and fix that through the tools that we ordinarily have and the tools that Western governments started to deploy in the 1970s when we had rampant inflation. So that's the gamble other countries are making. It's something that I think the US should think fairly strongly about. So quick stimulus, directly to households, directly to employees to keep them on payroll, directly to businesses to keep them functioning and floating. The trade-off is what kind of governance do we need? What kind of oversight do we need on the other hand? But time is of the essence. The one thing that I think we ought to also focus on is if we add conditions to stimulus funds, conditions like no stock dividends and no stock buybacks. That's not just a matter of fairness. It's not just a matter of people using stimulus for improper, inappropriate uses. It's also a way of preventing leakage from the stimulus to make sure that the monies that we're spending, even though they're massive, go straight into keeping businesses afloat and keeping workers on payroll and helping ordinary Americans. So we have to come up with a dividing line between conditions that would be nice if we had the luxury of a lot more time and a lot more careful drafting versus conditions that are essential to democratic accountability and essential to making macroeconomic stimulus really work and really go to where it's most needed. So let me then turn back to Professor Orian Peer.
Okay, so a few quick points before we wrap up and move to Q&A, because I'm sure people have lots of observations and issues they'd like to discuss. So one issue that I saw coming up in the commentary is a really important question. How is the Fed going to fund all of this? So you know, when we're talking about measures that are likely going to expand the Fed's balance sheet by to the tune of $4 trillion, U.S. GDP is about $20 trillion. That is a real question. So here's the answer. The answer is that the Federal Reserve is special. Okay, the Federal Reserve has the legal prerogative to monetize assets. So what that means is that when the Federal Reserve purchases assets, okay, that's an increase on the asset side of the balance sheet of the Federal Reserve. The Fed credits reserves in the accounts of the commercial banking system. Okay, so let's say Professor Gerding is selling a bond to the Federal Reserve. It's obviously not going to be Professor Gerding that's selling the bond. It's going to be some giant primary dealer. But the basic principle is the same. The Fed is going to credit reserves into Professor Gerding's bank account, and the bank is going to increase the deposits that Professor Gerding himself holds in the account. Okay, so what does that mean? What is funding the bonds? What is funding the bonds is basically reserves. And the critical thing to understand is that banks do not choose to hold these reserves, okay? And this has nothing to do with, some of us have learned about reserve requirements in micro and macroeconomics classes or something like that. It has nothing to do with reserve requirements. Only banks can, with very few exceptions, only banks can hold accounts in the Federal Reserve. What that means is that even though an individual bank might try to get rid of reserves, okay, they make more loans, etc., at the system level, these reserves are just going to be circulated around between banks. Okay, so let's see what this looks like in terms of data. Okay, we still don't have the new data, but you can see QE, the 2010s QE after the 2008 crisis, and you can see that when we start here, the Federal Reserve's balance sheet was very small. You know what? Let me send you all the URL so you can. One second. Okay, I will do that in a little bit. What you can see here is that before the crisis, the Federal Reserve's balance sheet before 2008 was very small. Okay, it was about $1 trillion. Right, very small. What happens with the crisis in QE is that assets increase. So you see all this blue and this light blue stuff, and this is all U.S. Treasury securities here, and agency. So basically, publicly backed, mortgage-backed securities over here in the light blue. Okay, so the balance sheet expanded from 1 trillion to 4 trillion. That's what QE looks like. Now take a look at what is happening on the liability side. This pink and lighter pink. You can see that currency is going up a little bit, right? There's this secular growth in the public's demand for cash, but that's a fairly stable trend. It has almost nothing to do with the Fed's actions. What really grows, okay, is this darker pink area. And what is that? That is other deposits with Federal Reserve banks. So what are those other deposits? They're basically bank reserves, okay? Banks have absolutely no discretion in whether or not they want to hold these reserves. Again, this has nothing to do with reserve requirements. In this sense, the Fed cannot run out of funding. It's not like you or I. It's a sovereign issuer of the dollar. Okay, so that's basically what that looks like. Last thing before we last couple of things before we turn to Q&A. Let me see how I can go back to. Okay, good. Last couple of things before we go to Q&A. So one huge issue that Professor Gerding mentioned is forbearance. Okay, so when the Fed and maybe the Treasury, if Congress passes the legislation, help people make payments, right? Help businesses meet payroll. Help students by forbearing on student debt, etc. They're easing the cash flow crunch, okay? But imagine what happens if this is imperfect. If this is imperfect, then it might be the case that I need to make large payments as an economic unit, okay? So I need to make payments to Professor Gerding, and I can't make them because I don't happen to be one of these businesses or households that is backstopped by the Federal Reserve or by the U.S. Treasury, right? It's not airtight. Not everybody is going to enjoy this credit and this payment to the extent of their liabilities. So what happens is that I stop paying, okay? And this could be I stop paying on inventories, I stop paying on my mortgage, I stop paying my rent, I stop paying payroll, I stop paying whatever, okay? There is another person on the side of that transaction, and that person was expecting payment, and now they can't make a payment, okay? So that basically puts them in the position that I was in, and that can basically create a domino effect of cascading defaults, right? So now Professor Gerding is not going to meet his payments. Now his creditors are not going to meet their payments. this could be a very, 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 very serious problem. So one of the things that we discuss about in the context of the emerging legislation, but also in the context of freestanding legal concepts and authorities, is how we can prevent people from defaulting, right? So what kind of forbearance can we get them under the law? And assuming that we cannot reclassify what just happened, we cannot ignore the fact that it's a default, how can we prevent this from clogging the bankruptcy system? Okay, bankruptcy is a very, very painful and expensive process. It's a process that threatens our ability to go back online in whatever capacity once the public health crisis is at least partially overcome. Okay, so these are big important issues. Last thing we wanted to say was the social safety net. Okay, the social safety net is not just a moral. It's not just a moral issue, although the moral issue is huge. Okay, it's also a stability issue. Okay, so when people don't have unemployment benefits, when people don't have health insurance, when people don't have affordable housing, okay, when people are burdened by large amounts of student debt, you can see how all of these things are recipes for large defaults. And again, these defaults are domino blocks that trigger further defaults, and can cause a system-wide crisis. So this is again why I think both of us think that that ensuring that the both Fed lending and stimulus money is distributed in an equitable and broad-based way is really a critical issue of economic policy in this time of Corona. Okay, and with that, let's hear what you all have to say.
Why don't we do this, Nadav? I'll make a few, like 2 minutes of concluding remarks, and in the meantime, if you read the chat, you can take the first question that strikes your fancy. Great. So let me just underscore a few things that Nadav said that I totally agree with. The first is we really have contract gridlock right now. If you think about this in terms of a small village, right? If I owe Professor Orian peer money, and he rents from Dean Anaya, and Dean Anaya has a loan out from Professor Krakow. My defaulting on my loan, or my defaulting on my debt to Professor Orian peer is going to have cascading impacts where he might have to default on his rent payment to his landlord. And his landlord, Dean Anaya, will have to default on his bank payment, potentially to his banker or his lender. If we were in a small village, the answer would be pretty simple, which is let's all just take a break. Let's all just have a moratorium where we just act like nothing is happening for the next couple of weeks. Like we'll just act like the calendar is not moving forward. We don't have that kind of collective mechanism in the US. We might see partial moratoriums, partial deferrals of different payments in congressional legislation. That's going to be critical. Unfortunately, it's not going to be total, so that there are parts of the economy, there are parts of our credit system that are still going to freeze up. And the problem is when our credit system freezes up, when our ordinary debt contracts, ranging from household debt all the way to rent payments and mortgage payments, all the way to big business debts, when those are not repaid, our court system, our bankruptcy court system, our system for dealing with landlord tenants is just not equipped to deal with a tsunami of defaults. So if there is a way that we can figure out how to have more flexibility, how to have more forgiveness, how to have just a more informal credit system for the next couple of months, that would be ideal. But unfortunately, it's probably going to take some congressional action to hit pause on many of our most important credit markets. So that's one point. Our contract and bankruptcy system can't handle the tsunami. It would be better if we just hit pause on our complex system of debt in the United States. Point two is we do need at some point to move to reform. We do need to make sure that our financial system is a lot more robust and resilient. Professor Orian made a really important point that we need to keep remembering, which is that this is partially about making sure that household finances are more robust as well. There was a really famous Federal Reserve study from a couple of years ago in which 40% of respondents said that they didn't have $400 in their bank account to cover an emergency. Now, that study was criticized by a number of think tanks in DC, but we're now in kind of the acid test of whether households can handle just a few weeks of no income on a mass scale. And what Professor Orian said is exactly right. Part of why we have a social safety net, part of why we have, for example, Social Security, is because of equity. But part of it is also because it's in our collective economic interest. So when we have Social Security payments, that's partially to ensure that the elderly don't go hungry in our society. But it's also in part, the social part of Social Security is in part to make sure that there's some minimum level of spending if we hit a very deep recession or even a depression. So we have to think about how we make businesses, the financial system, and also individual households a lot more economically secure so that when the next pandemic, when the next whatever crisis hits, we don't have a matter of weeks before we have economic chaos. We have a lot more breathing room. So for that, let me turn it back to Professor Orian, who will read the first question that we want to talk about.
Okay, so I'll read a few of the questions because they're really excellent, and they're also, I think they're also in an internal dialogue. So Amanda asks, has a discussion about mortgage modifications right now in lieu of foreclosure, default, etc. emerged yet? Okay, so this is a question about basically about forbearance. Adrian is asking, what are some of the quote unquote zombie ideas that we should be ignoring as remedies in this crisis? And Professor Lowenstein wrote, isn't stimulus the wrong word and concept? Because when the economy is basically shut down, there is no economy to stimulate. We're just seeking to stave off total collapse, right? Okay, so let's bring this first batch of observations together. So as a discussion about loan and mortgage modification emerged, I think it's a complex answer. So here are a few different thoughts on this. One thing is that existing laws have some wiggle room, okay? And with mortgages, this typically varies state by state, but typically it's very hard to foreclose before a 90-day default. Okay, so that is going to be relevant depending on how long this goes. And one of the things that I think we can really do as a law school to serve our community is we can do a bunch of research and maybe offer a bunch of legal services that are going to help people with these already existing modes of flexibility, okay, under current law. They're going to run out. A second piece of this is that the White House declared that they were delaying forbearing on repayment of certain types of government-insured loans, okay, FHA loans, okay, which are, I don't know, maybe 10 or 15% of the market, but they're particularly relevant because they're made to moderate lower income households, okay? So these are the households that are likely going to be the most vulnerable. We can do this on a much larger scale if we wanted to, because the entire mortgage market is basically, almost the entire mortgage market is indirectly government insured. Okay, so if the government wanted to do this with conforming loans, that is a possibility. Okay, so yes, I think it is part of the conversation, but we're still waiting to see how this unfolds. Zombie ideas. So I think one of the zombie ideas relates to the comment that Professor Lowenstein made. Absolutely, we are not trying to stimulate the economy in a traditional way just yet. Okay, economic activity would have to stay low. That is a feature, that is not a bug. We want people to stay in their homes. We don't want them going to restaurants and going shopping and going on vacations. Absolutely not. So yes, this is about life support. Okay, the day will come, maybe in a couple of months, when we need to start thinking about stimulus. We clearly have more urgent things to do now. So the idea that ordinary stimulus might work, that is a zombie idea, I think, personally. Checks in the mail, so this idea that writing people checks is going to solve the problem, it's going to help, but it's not going to help because of stimulus. It's not like we're somehow increasing the money supply or aggregate demand or something like that. It could help if it affords a safety cushion, a buffer to vulnerable households that will either have to default on payments. Okay, so this goes back to Amanda's point. Okay, mortgage payments, rent payments, loan payments, etc. So it could help with that, and it could help with making sure that aggregate demand doesn't fall unnecessarily because people can't afford food. Okay, because people can't afford utilities, because people can't afford healthcare. Okay, because people can't afford all of these things that would basically turn this into a humanitarian crisis. Okay, so where does this take us back to? This takes us back to this notion that if checks in the mail are going to be effective, they have to be made where it matters. Okay, it's not about stimulating the economy in some abstract sense. It's about channeling funding into the most vulnerable units that would otherwise default financially or not be able to afford basic provisions as a consumption matter. Okay, passing it on.
So let me put a couple of different spins on that. So I think there is a role for checks to every American in terms of not just a humanitarian response, but also the kind of aggregate demand point that Nadav is making. And this is one of those things where if we spend a lot of time to finely tune who gets a check, we're losing valuable time. So even Alexandria Ocasio-Cortez over the weekend said that she's fine with millionaires and billionaires getting checks because it's so important to make the payment quickly. The second thing that I think is important is on top of those individual checks, I do think it's incredibly important that we try to keep employees on payroll so that we essentially maintain the relationship between employers and employees so that whenever the health crisis is over, we can hit the restart button as quickly as possible. Having employees laid off is incredibly destructive. It's incredibly destructive to households. It adds a great deal of uncertainty to households. And it also, I think, starts to destroy that key relationship between employers and employees. There's a lot of frictions in rehiring employees when a crisis is over. Businesses might fear that the pandemic would come back. They might fear that they don't know what the future holds for them. At the same time, I do think that there's a behavioral difference where an employer might be more reluctant to fire someone who's already on payroll in 6 months than they would be to rehire that same person. So this is an argument that I had many times over the weekend with different professors and people in DC, which is preserving the relationship between employers and employees is critical. One huge problem, though, we have is that there's a lot of self-employed people out there. There's a lot of people in the gig economy who are just not on payroll. So we need to find a way to give them checks as well, because the independent contractor, the gig economy, has meant that a lot of people, including people who might be delivering food to you today via Uber Eats or whatever, are just don't have any economic security. And we need to figure out a way to cover those workers, those households, that kind of part of the economy. And longer term, again, we need to figure out how we have more economic security overall. Nadav, do you want to ask another question?
Yes, I'm going to read out. I'm going to read out questions. So Chris is asking: is the social behavior aspect of the economy part of the reason why governments have been holding off on tighter or more restrictive social distancing measures? So I think reading this question, it sounds like, and Chris, please correct me if I'm wrong, to what extent is the public health response constrained by the dire economic consequences of social distancing? Okay, so I think that's a key issue. April is asking, if Congress can't pass an equitable bill in a timely manner, is it better to pass any stimulus package and deal with the inability to reach an equitable solution as complications arise, or continue to wait for Congress to pass on an appropriate bill that reaches the households that most need it, right? So again, about this speed versus getting it exactly right trade-off. It seems that leaving it up to Congress to balance the need for equity, the level of oversight required, and the need for immediate action might be wishful thinking. What follow-up measures does Congress need to take if they pass a bill that doesn't sufficiently support the households and businesses that need it? Okay, says Gerding actually just kind of answered my question, right? So let's talk about this. It definitely seems to be the case, just by casual observation reading the newspapers, that the severity of the economic downfall absolutely has been an issue that was weighing on the executive branch in the way that it handled that. That's a personal opinion. That's not so much a matter of economic policy expertise, but just casual reading of the newspapers, that that this was a huge factor going into the public health response, especially in the months leading up to an election, right? So this is completely intertwined with the election cycle. About the equitability of the bill and what that would mean, I think that's a really deep question, and it's very hard to make predictions. Here's something that I'm awfully concerned about with these bills. We're talking about lending to households and businesses. Lending could be very helpful. It buys us time. It gives bridge finance, especially if the loans come at 0% and they're broadly distributed. It still doesn't address the fundamental issue that there are many businesses and households that are going to be so severely hit by this crisis. If you think of airlines, if you think of theaters, if you think of sporting venues, we could think of many other examples, that borrowing is not going to fundamentally improve their situation. So what these businesses and households need is basically capital investment from the government. And we've had something like this in 2008. It was called Tarp. Okay, for those of you who were following the 2008 financial crisis, the Troubled Assets Relief Program, and it was a multi-hundred billion fund that was designed to recapitalize mainly financial institutions, because Professor Gerding said that was the epicenter of the 2008 crisis, but also the auto industry, okay? And also to provide, at least the intention was to provide some capital for mortgage restructuring. And there's been a little bit of talk in the current legislation about doing that. So a lot of these loans to small businesses, these SBA loans to small businesses, they're actually grants. The government is going to the government is not going to actually demand repayment of these loans. Okay, but it might very well be the case that we find ourselves in a need to offer to take a capital stake in large in large areas of the U.S. economy, especially if the virus threat becomes a recurring theme in the next few years going forward. That is going to be very difficult to do politically. Okay, there's a word for the government taking an equity stake in entities, in private entities. It's called nationalization, and it's a word that carries a huge stigma in our political system. And I think that part of what will happen is that we will have to get more comfortable with it.
Well, I don't know if I agree with that, Nadav. I mean, I think there's a difference between taking a small equity stake and owning the entire company and the entire industry, right? So what we saw in 2007, 2008 through the Tarp program was the government basically taking warrants, which is essentially a right to buy stock in the future. And that, I think, concerns me less, and I think that's actually makes sense in terms of good economic policy. So I think I think there's a very big difference between nationalizing an industry and taking an equity stake. Taking an equity stake is still not unproblematic, right? Like, you have to figure out how is the government going to get voting rights? How is the government going to dilute existing shareholders? What does that mean for the incentives of shareholders to contribute more capital in the future? How is the government going to offload those stakes? But I do think that sort of equity stakes via warrants is something that is doable and is probably necessary to make the big industrial portions of the stimulus work. Can I have a couple responses to some of the comments or questions? One thing that I really recommend that we all do at this point is keep a diary, not just of your personal life, but of what's going on in our legal system and what's going on in Washington day by day. Because it's one thing to sort of look at decisions that policymakers, decisions that lawyers, decisions that state governments are making through the comfort of history. It's another to sort of think, as April's question suggested, what's the real trade-off that a policymaker has in real time, where there's extremely high stakes, the law is somewhat unclear, and there's a real nasty trade-off to be made. So one trade-off we have is, as April suggests, getting the bailout exactly right, making sure it's equitable. So we do need it to be quick. We do need it to be massive. The trade-off, though, is that Congress might balk at a fourth bailout bill, right? If the size is really big, a lot of senators, a lot of members of Congress might say, I've had enough, I'm going home. Or I have to self-quarantine, I'm not even showing up for a vote. So there's a trade-off between not getting it perfect, but also realizing that this might be our best shot at the apple. And there is something to be said for taking a little bit of time to make sure that it really does have the economic effect that we want, and that it's reaching the households and the sectors of the economy that we think are absolutely necessary to put on life support. Another thing that strikes me is we're essentially living through a period of, or a version of the debates that we saw in the late 20s and early 30s, right? I mean, there are some concerns about democratic accountability. There are some concerns about rule of law. It's just that the seats at the table have totally changed, right? So now the distrust is not of FDR and giving him too much power. The distrust is of giving Secretary Mnuchin too much power or giving his boss too much power. To what extent do we need to build in safeguards that that keep in some democratic accountability, some principles behind our bailout? So there's a really nasty Faustian trade-off that we're facing right now in real time. And I think that this is incredibly important for students and faculty and staff to think about day by day. Write it down, write about what bothers you, because this is real-time history right now.
Thank you. Just a quick closing remark. So first of all, thanks for everybody for you know, for us getting together and holding this as a community event, and thanks for the just incredible voices that were raised and the very important issues. One last comment that I wanted to say something about. April is asking what is going to be the impact on undocumented workers, dreamers, other people that live in the system that do not have access to the necessary healthcare, etc. So I personally don't know the answer to that, but we have really amazing resources at CU to ask these questions, right? So we have people like Professor Ming Chen and like Professor Craig Coneth, and we have you know, we have an extremely skilled student body. And I think one of the things that we can do as a community in these next months to come is to build on all this essentially all this human capital and all this community capital that we have as, you know, as people who care about these issues, and try to see what we can do in studying them and trying to see what kind of clinical help we can offer to folks less fortunate than ourselves. Okay, thank you very much. This has been amazing, and we'll keep in touch. Yeah.
Let me make a couple of closing remarks on my part, so please indulge me. Please take care of yourselves out there. Reach out to one another. It's incredibly difficult. We don't know what kinds of stresses each other are under. We're going to live through, honestly, a couple of dark weeks ahead of us. And for those of you who are on the younger side, think about it this way. When we talk about the greatest generation who lived through the Depression and World War II, they were essentially kids. They were essentially your age or younger when some pretty horrible, dark times happened. And they got through it. So when the recovery happens, when we are asked to rebuild our economy, we're going to need your creativity. We're going to need your ingenuity. And it's going to be a huge amount of work for lawyers to rebuild our institutions that make our society work, that make our markets work, that make our economy work. And that's going to be an incredible opportunity. It's going to be an incredible challenge that's going to fall on your generation more than ours. So we see through a dark glass now, but soon we'll be face to face, and then we'll be able to get to work. Thank you very much. We're happy to keep taking questions. We'll write them down offline. We'll figure out a way to maybe put some resources up on the websites. But thank you very much.